Hey everyone, welcome back to Conviction Bet. Hope you're doing well. It's been a strange few weeks out there. The S&P 500 closed above 7,700 for the first time. Semiconductors came roaring back from July's AI wobble, and the argument at the Fed has flipped from when they cut to whether they hold or have to hike again. So everyone is now very confident about something they were confident about the opposite of 6 weeks ago. And speaking of confidence, with about 88% of the S&P 500 reported, 86% have come in above EPS estimates. In an aggregate, reported earnings are more than 29% above estimates, which FactSet says is the largest earnings surprise on record since they started tracking it in 2008. At some point, somebody has to ask what precisely was being expected. Although take out Alphabet and Amazon and that 29 drops to about 11, hold that thought. Amazon is going to matter later. But here's what's actually been on my mind. 2 men, no analysts, no leverage, no shorting, no derivatives of any kind. 2 substantive partnership letters a year and a written belief that more frequent, detailed reporting could make them worse investors. 12 and a bit years. 921% against 117 for the index. Then they closed the fund, handed the money back, and published the complete collection of their partnership letters for free on a charity website. The market is telling a story about 2 men who found the perfect framework and got rich holding 3 stocks. The real story is about what happens to a framework once it stops being a process and becomes a document. I'm J.L. Maurer, and this is Conviction Bet. We believe the stories that move your portfolio are usually quieter than the ones that move the tape. Here's where we're going. Their entire framework has been a free download for 5 years, which has made it one of the most copied ideas in quality investing. I'm going to argue that the copy is worth far less than people think, and I'm going to test that against the most interesting case I know. Nick Sleep running his own framework on his own money after the letters stopped. The public record is incomplete. What we can see of it is uncomfortable. Let's start with the record, because the record is the reason anyone is listening. The Nomad Investment Partnership launched in early September of 2001 and began investing on the 10th, one day before the 11th. That is not a detail anyone planned, and it tells you something about how little the calendar cares about your entry point. It was run by Nick Sleep and Qais Zakaria Zach. Sleep read geography at Edinburgh and then took an apprenticeship at a landscaping firm, which is not the standard route into global equities. Zakaria was a Cambridge mathematician who had covered Asian equities from the sell side through the Asian financial crisis. They met at Marathon Asset Management in London, the firm Jeremy Hosking co-founded, and the home of the Capital Cycle School of Investing, which looks for industries where money is leaving rather than arriving. Remember Hosking. He comes back at the end, and he's the contrast case for this whole episode. Nomad started life inside Marathon before spinning out as an independent partnership in 2006. From inception to the end of 2013, Nomad returned 921.1%. The MSCI World Index returned 116.9. $1 in the index became about $2.17. $1 in Nomad became $10.21 annualized. That's 20.8% a year against 6.5% for the index. And I want to be precise because this number gets quoted carelessly. The final letter reports 20.8% before performance fees. For a partner invested from inception, the corresponding net of all fees result was 18.4%. Still close to triple the index, compounded, for 12 years. And because the hurdle was measured from the point each partner actually invested, individual net results differed from one another. One more piece of precision, because almost nobody gets this right. September 10th, 2001 to the end of December 2013 is about 12 and a quarter years, not 13. And you can check that yourself. 921% over a full 13 years would only be 19.6% a year. The 20.8 only works over 12 and a bit. Over the life of the partnership, they made something in the order of $2 billion for their investors, who were mostly charitable foundations and university endowments. And then in 2014, in their mid-40s, with the machine running perfectly, they turned it off, gave the capital back, told their partners that owning Amazon, Costco, and Berkshire Hathaway for the next decade would probably beat whatever else was on offer, and went into philanthropy. 7 years later, they published the whole archive, 110,000 words of it, on Sleep's charitable foundation websites, where it sits today. You can read every letter tonight. It costs nothing. And that is exactly why so many people have drawn the wrong conclusion from this story. Because when the manual is free and the record is spectacular, the obvious move is to read the manual and copy the answer. The obvious move is wrong, and the rest of this episode is about why. Now, to understand what they built, you have to understand what they were doing before they built it. Because the framework was born out of a mistake, and it's the mistake that matters. For the first 3 or 4 years, Nomad was not a quality compounder fund. It was a cigar butt fund. Cheap, ugly, broken things bought at a discount to what they were worth, sold when the discount closed. Sleep's stated aim in the early letters is almost comically blunt. Buy dollar bills for 50 cents. At the end of 2002, he tells his partners the portfolio is priced at roughly 50 cents on the dollar of what he thinks it's worth. 25 companies, 8 countries, 22 industries. Take Xerox. Accounting scandal, SEC investigation, credit markets slammed shut, the shares down to 7% of their peak. Sleep's read was that the accounting fight was noise. $6.4 billion of revenue had been booked in the wrong years out of about $90 billion, and cash flow was completely unaffected because customers kept paying their monthly bills either way. He valued the business at roughly 4.5 years of free cash flow. And then there's Stagecoach, which is the one that changed everything, so stay with me. Stagecoach was the largest bus operator in the United Kingdom, founded by a man named Brian Suter, who had started his career as a bus conductor and was, in Sleep's telling, extremely good at doing simple things properly. Collect the fares, run more buses at rush hour, paint them bright colors. The shares went from 20 pence at listing to £2.85 by 1998. Then Suter semi-retired. The next generation of management bought an overpriced American roll-up with borrowed money. The UK business got neglected, and the shares fell to 10 pence. Below half the float price, a decade after the float. Nomad bought at 14 pence. Suter came back, sold the bad assets, repaid the debt, refocused on buses. Sleep's own written estimate of fair value was around 60 pence. It became the largest position in the fund. And then they started selling it. The thesis worked, the discount closed, the money got recycled into the next 50-cent dollar. Textbook. By his own account in the letters, Stagecoach paid for the failure of another position, Conseco, 6 times over. Here's the part that stuck with them. Stagecoach didn't stop at 60 pence. By the annual letter at the end of 2003, with the selling already underway, Sleep records the share price as having risen 6-fold from their purchase. That's around 84 pence. Already past his own estimate of what the whole business was worth, and it kept climbing for years after that. Think about the shape of that. They were right, they got paid, and the paid part was a fraction of what staying would have been worth. And Sleep writes about this with a kind of controlled fury that you rarely see in a shareholder letter. His line is that the industry ignores this category of error entirely because opportunity costs go unrecorded in performance records. You get no penalty. Nobody audits the position you sold too early. The mistake is invisible, which is precisely what makes it dangerous. That's the crack the whole framework grew out of. Not a winner. A win that should have been enormous and wasn't. So here's the investor implication, and it's an uncomfortable one. If you're tracking your own results, you almost certainly track what you bought and what it did. You almost certainly do not track what you sold and what it did afterward. Nomad's entire second act came out of building that second ledger. And if you don't keep one, the most expensive thing in your portfolio is a number you will never see. So here's where it gets interesting. In 2002, Nomad put 3.1% of the fund into Costco. 3%. A small position in a boring retailer at $30 a share, down from a high of $55. The market's complaint at the time was that Costco's margins were too thin and the company refused to fix it. What Sleep saw was a contract. Members pay an annual fee. In exchange, Costco marks up branded goods by 14% and its own label by 15%, and that's it. Every efficiency the company wins goes back to the member as a lower price rather than to the shareholder as a fatter margin. The fee is nearly all the profit. The merchandise business roughly covers its own costs. And there's a story in the letters told to Sleep by a Costco director that I think about constantly. Costco bought 2 million pairs of designer jeans through a routing arrangement that got the landed cost down to around $22 a pair, about $10 less than they had previously sold the same jeans for, and roughly half what other retailers were paying. A buyer suggested taking a bigger markup this once. Nobody would know. Jim Sinegal, the founder, said no. And the reason he gave was not about margins. It was, if I let you do it this time, you will do it again. In 2004, Sleep writes the sentence that made his career. He says that in the office, they keep a whiteboard listing the very few investment models that work and that they understand, and that Costco is the best example of one of them. Scale efficiencies shared. Later renamed scale economics shared, same idea. Most companies chase economies of scale. Almost none of them share the proceeds. And the sharing is the whole thing because it converts a cost advantage into a growth engine. Lower prices bring more customers bring more scale brings lower costs. The company grows by giving more away. Now here's the metaphor I want you to hold for the rest of this episode because everything turns on it. What Sleep and Zakaria did over roughly 4 years was cut a key, not a theory, a key, a specific physical shaped thing that opened one specific lock, and then when they tried it, opened several more, and they kept filing it. In 2005, they added a measuring tool they called the robustness ratio, how much value a company hands its customers for every dollar it keeps for shareholders. At Costco, they estimated the customer saved about $5 for every dollar the company retained. At Geico, which Buffett had described in similar terms, the split was closer to 1-to-1. Sleep's question in the letter is simply, look around you. How many companies save $5 for their customers for every one they keep? Then they asked the next question, and this is the one that made them rich. If sharing scale is the best model, what's the least capital-intensive way to run it? Because a Costco warehouse cost about $15 million, served a 30-mile radius, and had to be built one at a time. The physics of the model were beautiful. The physics of the expansion were heavy. In the 2004 letter, he works through it out loud and lands on the internet. He notes that $15 million is a lot of servers, and that for a business online, the incremental assets required to grow are so small. He half jokes that maybe Costco isn't perfect, and maybe they should own eBay as well. In 2005, they started buying Amazon. By 2006, they wanted Amazon at 20% of the fund past their own stated concentration limit and had to go to their partners for permission. A chunk of the partnership left rather than agree. They did it anyway. And by 2007, Sleep was pulling in work from the Santa Fe Institute, Jeffrey West's research on biological scaling laws and applying it to internet retail. The logic being that if you want an organism to grow from a mouse to an elephant, its basic structure has to be simple enough to scale without being rebuilt. Same for a business. The simpler the self-reinforcing loop, the further it runs. Then they ask the last question in the chain, and it's my favorite thing in the entire archive. If this model is so obviously good, why hasn't everybody noticed? Sleep's answer has 3 parts. 1, most investors are running the wrong mental model because they're used to companies that have a single good idea and then can't repeat it. 2, it's structural and behavioral. In his words, active fund managers have to look active. 3, people don't believe in the longevity of compounding. Conventional wisdom says good things don't last. And on average, he concedes conventional wisdom is right. And then he writes the sentence that pays for the entire framework. Investors know that average companies eventually fail, so they discount every stock for that risk, including the ones that, in the end, don't fail. Which means the shares of genuinely great businesses can stay cheap, not for a quarter. In some cases, for decades. That's the whole opportunity, laid out in 2 sentences in a letter 20 years before anybody was reading it. And by 2004, they were already keeping a list in the office. Headed super high quality thinkers, 15 businesses, no more, which they call the terminal portfolio, the place they intended to end up. So here's the investor implication for this movement. The thing that generated those returns was not the conclusion, buy Amazon and Costco. It was 4 years of chained questions. What is this? Why does it work? What's the cheapest version of it? What does biology say about how far it can run? If you skip to the last line, you have the answer to a question you never asked, and you will not recognize the day it stops being the right answer. Now, before we get to what broke, I want to spend a few minutes on the part of this story that you can actually use tomorrow because it's the part that gets the least attention and it's worth real money. Sleep and Zakaria ran scale economics shared on their own fund. Deliberately. Start with the fees and get this right because most retellings don't. While Nomad was still running inside Marathon, they charged 10 basis points, 0.1%. When they spun the partnership out, they said plainly that 10 basis points would not cover the cost of a standalone operation, so they replaced it with a cost reimbursement fee capped at 1% and falling as a percentage as assets grew. Read that again. Not a fee designed to make them money. A fee designed to pay the electricity bill, with a ceiling on it shrinking as the fund got bigger. Which is, and I don't think this is an accident, scale economics shared, pointed at their own investors. On top of that, they took 20% of profits, but only above a 6% annual hurdle. And then 5 years in, they did something almost nobody does. Sleep noticed that because performance had been so strong, the compounded hurdle was now so far behind the actual results that Nomad could earn money market returns for the next 30 years and still collect a performance fee the whole way. Contractually earned. Economically absurd. So he wrote to his partners and said, look at the conflict, and then changed his own contract against himself. The performance fee went into a reserve account, at risk for 5 years, refundable if they failed to clear the hurdle. He tied the payout period to the holding period of the investments. Warmly. That is a beautiful piece of design, and it took a voluntary pay cut to build it. Then there's how they handled money coming in. By the middle of 2004, the partnership was just over $100 million, and Sleep declared it closed. $100 million. He writes that if they had run the industry standard open house, the fund would have been roughly 3 times bigger and the results worse and the quality of the partners meaningfully impaired. He says plainly that to that point, they had declined almost as many investment dollars as they had let in. And then he adds the line that gives it away. It's a ratio the industry does not track and a habit the industry is not good at keeping. They reopened only when prices were bad. Which is another way of saying they asked their investors to be brave at exactly the moment. Investors are usually running, and when they did open the queue in May of 2004, every partner in it consented within 48 hours, several offering more. Even the writing was a filter. 2 letters a year in essays about destinations, not monthly tables. And he tells his partners why, in writing. More regular reports, daily, weekly, monthly, or otherwise, are likely to be of little value to you and may even be counterproductive for us. A fund manager telling his own investors that hearing from him more often would make him worse at the job. So here's the so what, and it's the most portable thing in this episode. The next time you're evaluating a fund, a manager, or a platform, don't start with the returns. Start with 3 questions. How does the manager get paid when you don't make money, and does that structure reward gathering assets? Does the manager ever refuse capital? And does the reporting cadence encourage you to hold or to fidget? And take that first one carefully, because Nomad did charge a management fee in bad years. That isn't the test. The test is whether the fee is a cost recovery or a profit center, because a fee that scales with assets pays a manager to get big, and a fee capped at cost pays him to get it right. Nomad eventually answered all 3 in the investor's favor in writing years before the final record was known, and in the fees case, by rewriting its own contract against itself. Those answers are checkable on anything you own. Now, here's the part of the story that almost nobody tells, and it's the reason I wanted to do this episode at all. In 2014, they closed the fund. By the end, Nomad was concentrated in Amazon, Costco, and Berkshire Hathaway. Sleep and Zakaria kept those positions personally. A London entity called IGY Limited, whose filings Sleep signs, has reported the same 3 US-listed holdings quarter after quarter. Amazon, Costco, Berkshire. Turnover, 0. And I need to put the caveat right here rather than saving it, because it matters more than the number does. A 13F only covers reportable securities in practice, mostly things traded on a US exchange. It doesn't show cash. It doesn't show private holdings, and it doesn't show ordinary shares listed only in London. So this is a window, not a portfolio. Keep that in your pocket for the next 10 minutes. And in the spring of 2021, writing the preamble to the published letters, Sleep and Zakaria allowed themselves a rare bit of triumph. With a few months to go to Nomad's 20th anniversary, they wrote that it was now all but inevitable that their annual performance would be around 20% for 20 years. Evidence, they said, that investors really can make their money sitting on their assets. Hold that date in your head, spring 2021, because 3 years before that, something had happened that they don't mention there. In 2018, Amazon had grown to more than 70% of Sleep's personal net worth, and he got uncomfortable. He asked himself whether there was a ceiling even to Amazon, and he wasn't sure. So after 13 years of holding, he sold half his position in a single day at $1,500 a share. He told the journalist William Green how it felt. Carefully, he said, "I hated it. I felt horribly conflicted, and I'm not sure it's a good decision." Read that against his own letters, and the tension is obvious. This is the man who wrote that the biggest error in investing isn't the stock that goes to 0. It's the great business sold too early, the invisible mistake, the one nobody audits. And then he made that trade, knowing exactly what it might cost. But I want to be fair to him, because the easy version of the story isn't right. He sold half, not all. And a single stock at 70% of your personal net worth is not the same problem as a single stock at 7% of a fund. Trimming that is defensible risk management, and it can be the correct decision even if the stock then triples. Carefully. The framework doesn't resolve that neatly. Business conviction and personal concentration risk are 2 different questions, and the letters are mostly about the first one. Then he sat on the cash, and by 2020, he had put it into a 4th position, ASOS, the British online fashion retailer, a company Nomad had owned inside the fund. When he and Green spoke, it had already doubled. Now look at what the key opened. And I want to do this carefully, because the lazy version of the story is that ASOS blew up, and that isn't what happened. Take the most recent half, the 26 weeks to the 1st of March. Adjusted revenue of £1.1 billion, down 14%. Gross merchandise value down 9%, but the loss before tax narrowed from $242 million to $138 million. Adjusted profitability up 51%. Gross margin up another 330 basis points to 48.5%, the operating repair is real. It is also incomplete. In that same half, free cash flow was an outflow of £93 million and net debt went up, not down. So what does the framework actually say about that? Here's where I have to be honest about the limits of what I can claim. Margins rising while the business shrinks should, through Sleep's lens, at least make you uncomfortable. But it is not proof that ASOS is clawing back value it used to hand customers. Higher gross margin can come from less discounting, better inventory, fewer returns, cheaper sourcing. In ASOS's case, a chunk of it is an accounting shift. The company now books commission on flexible fulfillment instead of gross sales, which mechanically lifts the margin and lowers the revenue line. There's a detail that cuts the other way too, and I'd be a coward to leave it out. In that same half, ASOS deliberately raised marketing spend as a share of revenue explicitly to reinvest efficiencies back into winning customers. New customer acquisition turned positive in March for the first time since 2021. That is not a company running the Costco contract in reverse. It's a company trying to rebuild one. Whether it can is genuinely unresolved. What is clear is what arrived while the framework sat still. Back in 2024, global data projected Shein would overtake ASOS in the UK apparel market by 2027. A supply chain and a cost base the letters never contemplated. And as of March this year, Mike Ashley's Frasers Group had become ASOS's largest shareholder. And remember the caveat, ASOS is UK listed, so it never appears in those quarterly US filings. I don't know whether Sleep still owns it, what he paid, or what he's done since. William Green, who has actually spoken to the man, put it about as carefully as it can be put. It hasn't worked out so far while allowing that Sleep may still turn out to be right. Now compare that with the 3 doors. The key was originally cut for beat. They're all still open. Costco in the quarter ended in May. Net sales of $69.2 billion, up almost 12%. Gross margin just over 11%. Operating income of $2.8 billion, of which $1.37 billion is membership fees. Which is to say, 24 years after Sleep described it, membership fee revenue alone is equivalent to roughly half of Costco's reported operating income, while the margin on actually selling you things stays deliberately, almost stubbornly thin. Renewal rates in the US and Canada, 92.2%. And Amazon. Quarter ended June, revenue of just over $200 billion, up 20%, operating income of $27.5 billion, up 43%, and free cash flow over the trailing 12 months of negative $7.6 billion because capital spending ran to $169 billion, and the company has guided to around $220 billion for the year. And be precise about what that means, because the shorthand version is wrong. Amazon is generating enormous operating cash flow, $161 billion over the trailing year. It's the infrastructure spending that's larger still, which is what tips free cash flow negative. Sit with that anyway. The most common complaint about Amazon through this earnings cycle is that it refuses to let profit show because it insists on building dryly. Structurally, that is remarkably close to the argument Sleep was answering in 2005. So here's the investor implication, and it's the thesis of this episode. The key still opens the locks it was cut for. Amazon and Costco still run that loop with remarkable clarity, and inside Berkshire at Geico especially, you can see the same principle at work, which is exactly where Sleep first found it. What we do not see in the public record is another Amazon or Costco-sized success generated afterwards. And I have to say it that way because that record is incomplete. Absence of evidence in a portfolio you can only partly observe is not evidence of absence. Now, let's bring this back to what it means for you, and I want to give the bear case its best shot first because there's a good one. And I know what the bear case is. It goes like this. This is survivorship bias with excellent pros attached. Two clever men bought Amazon early. Amazon became one of the great business stories in history, and everything else, the whiteboard, the robustness ratio, the scaling laws, is a narrative built backwards from a lucky outcome. On that reading, ASOS doesn't prove the framework expired. It proves the framework was never doing the work, and the three winners were noise. That is a legitimate concern, and part of it is simply true. Luck was involved. Sleep says so himself in the final letter that all he and Zach did was catch some better waves and try to ride them to the shore. I'm not going to pretend a 12-year record from a two-man shop settles a statistical question, but here's specifically why the framework survives it. The date, scale, efficiencies shared appears on the page in 2004. The robustness ratio in 2005. The scaling law extension in 2007. Amazon goes to 20% of the fund in 2000, 6 years before the outcome, at a moment when it was contested enough that partners walked out over it. That is a costly, dated, written down prediction. That is not a story assembled afterward. And the ASOS episode doesn't weaken the case. It sharpens it. If this were pure luck, a later loss would tell us nothing at all losses are what luck looks like. What makes ASOS informative is that the same framework held by the same man applied to a business that looked like the pattern online, low price, sharing scale, has not so far produced the outcome. And there's a wrinkle here that I think is the most interesting thing in the whole episode. One of the criteria didn't actually hold. Nick Robertson founded ASOS and ran it for 15 years and stepped down as chief executive in 2015. By the time Sleep bought the shares personally, ASOS was being run by a former accountant who had come up through the finance function. A good operator, not Jim Sinegal refusing the markup on the jeans. So there are at least two readings, and I can't settle between them from the outside. One, the framework held and the world moved faster than it did. Shein arrived with a supply chain the letters never contemplated. Two, the business never fully satisfied the criteria in the first place, and the pattern was matched on the surface rather than checked underneath. Notice that the second reading is worse for the copyist, not better. Because pattern matching on the surface is exactly what you do when you inherit an answer instead of building one. And there's a contrast case sitting right there in the same story. Not a controlled experiment, nothing like it, but a useful one. Jeremy Hosking, the man whose firm they both trained at, he left Marathon in 2012 and started his own shop in 2013. 1 year before Nomad closed. He's still running money, still contrarian, still deliberately diversified. And here's the part that stopped me. On his firm's own account this year, the strategy is underweight technology overall, and yet it has been holding the memory chip makers since 2013. SK Hynix, Micron, Samsung. Not because anyone forecast the AI boom, because capital cycle analysis said that when each generation of chip needs more capital than the last, the weak players go bankrupt or get absorbed. And over 3 decades, the number of serious memory makers fell from more than 30 to 3. 3 survivors, all of them disciplined about spending, sitting there when demand exploded. Warmly. That is a 30-year-old framework producing a brand new answer about the most crowded trade on Earth. Same intellectual ancestry at Marathon. 2 completely different frameworks grown out of it. One pair abstracted a single model, concentrated everything into it, said publicly that they had solved the problem, and left the industry. The other man kept the general engine running, and it is still generating answers he didn't have 13 years ago. I don't think one of them is right and the other wrong. I think that's the choice, and most people copying Nomad don't realize they're making it. So let me land this. You can download their framework tonight. 110,000 words, free, on a charity website named after the International Geophysical Year, an international science collaboration that ran across 1957 and 58, whose advances were made available to all mankind rather than owned by corporations or countries. Which is, when you think about it, scale economics shared applied to knowledge. They shared the key on purpose, but a key is cut for a lock. Sleep and Zakaria spent from 2001 to 2014 as locksmiths, filing, testing, discarding, recutting, driven by a mistake nobody would have penalized them for. And then in 2014, the workshop closed. Not their minds. I have no idea what happened in there, and neither do you. The workshop. The fund wound up, the letters stopped, and the framework stopped being a process anybody could watch and became a finished object anybody could copy. The original doors stayed open. What happened at the new ones is much harder to see and much less clean. So when you copy the checklist, the moat, the reinvestment runway, the founder who won't take the extra markup understand what you're holding a copy of a key cut in 2004 for a world that has since had the internet rebuilt underneath it twice. It may well still fit. Amazon and Costco say it does, but you won't know the day it stops fitting because nobody sends you that letter. The men who wrote it didn't know either. So here's what I'd be watching. Not whether your framework is producing winners. That's the flattering test, and it lags by years. Watch whether it's still producing new questions. Sleep's 20-year run has one hinge in it. The moment he asked what Costco actually was, instead of what it was worth, everything after that was elaboration. If you can't remember the last time your own view of what makes a business durable actually changed, not the names in the portfolio, the criteria, then you're not running a framework anymore. You're holding a key and hoping. Anyway, that's this week. If you're enjoying Conviction Bet, subscribe wherever you get your podcasts, Apple, Spotify, YouTube, Amazon, whatever you use. Leave a review if you have 30 seconds. It genuinely helps new listeners find the show. Until next time, stay patient, stay skeptical, and keep your eye on the quiet stuff. I'm JL Maurer. This has been Conviction Bet.